Risk isn't just a buzzword in a boardroom. It is the invisible thread woven through every department of a modern company. To manage it, we must first see it. But what does risk actually look like when we peel back the layers of an organization? The most obvious place to start is the balance sheet. Financial risk is the heartbeat of corporate uncertainty. It manifests as market volatility, where a sudden shift in currency or interest rates can wipe out projected profits overnight. It also looks like liquidity risk, the nightmare scenario where a company simply doesn't have the cash to meet its immediate obligations. Moving deeper, we find operational risk. This is the risk of loss resulting from inadequate or failed internal processes. It looks like a critical system failure during peak hours, or a breakdown in the supply chain that halts production entirely. But it's also human. It's the risk of error, fraud, or even a lack of talent that prevents a company from executing its strategy. Then, there is the most fragile asset of all: reputation. Reputational risk is often the hardest to quantify, but the easiest to trigger. In the digital age, it looks like a single viral tweet or a poorly handled customer complaint that turns into a global PR crisis. Once trust is broken, the risk becomes a tangible loss in brand value and customer loyalty that can take years to rebuild. We cannot ignore legal and compliance risk. In a highly regulated world, staying on the right side of the law is a constant challenge. It looks like unexpected changes in legislation, new tax laws, or environmental regulations that require massive operational shifts. Failure here results in heavy fines, lawsuits, and in extreme cases, the total loss of a company's license to operate. Finally, there is strategic risk. This is the danger that the company's very direction is flawed. It looks like a competitor launching a disruptive technology that makes your primary product obsolete overnight. Or it's the risk of standing still, failing to innovate while the world moves on without you. The real challenge is that these risks don't exist in silos. They are deeply interconnected. A system failure can lead to a financial loss. A financial loss can trigger a reputational crisis. It's a domino effect that requires a holistic approach to management. Successful companies don't just avoid risk, they manage it by fostering a culture where risk is everyone's responsibility. This means robust internal controls, constant monitoring, and, most importantly, the agility to pivot when the landscape shifts. Modern technology, from AI to advanced analytics, now allows companies to predict and mitigate risks before they even manifest. But remember, risk also represents opportunity. Without it, there is no reward, no growth, and no innovation. The goal isn't to eliminate risk entirely, but to understand what it looks like so you can navigate it with confidence. If you found this breakdown of corporate risk helpful, please like the video and share it with your colleagues. And don't forget to subscribe for more insights into the world of business and strategy. See you in the next one.